Despite a high level of awareness, cryptos face new challenges from regulators. This is largely due to the advent of decentralized finance or DeFi companies. These companies aim to disrupt traditional financial institutions by building an alternative finance platform that leverages blockchain technology. But the growing popularity raises concerns about risks to consumers and investors as well as the stability of the monetary system. What is a cryptocurrency? A cryptocurrency is a digital medium of exchange that uses cryptography and blockchain technology for security and transaction verification. They aren't backed by any central bank, and instead operate on a decentralized network. This gives them autonomy from traditional financial institutions like banks and governments, and can empower consumers with greater control over their finances. Since their creation in 2009, cryptocurrencies have grown from digital novelties to trillion-dollar technologies that are changing the world. They can be used to purchase a wide range of goods and services, from software to digital real estate and even illegal drugs. Cryptos have also enabled a new generation of decentralized finance, DeFi, companies and projects that aim to provide users with access to financial services without the need for expensive legacy institutions such as banks and brokerages. Many governments are at a regulatory tipping point, weighing concerns about the potential for cryptocurrency abuse with the benefits that could be realized through greater adoption and clearer rules. Critics argue that cryptocurrencies have been used for illicit activity, and can't be trusted to replace existing monetary norms. There are more than 100 different cryptocurrencies in existence, but some of the most popular include Bitcoin, Ethereum and Dogecoin. Bitcoin has attracted a following with its promise of anonymity and high price volatility, while Ethereum's programmable blockchain platform has enabled developers to build decentralized applications. Dogecoin, meanwhile, was created as a meme-based currency but has become popular for its fun and accessible nature. These tokens are fungible, meaning that once they're sold or traded, their value stays the same. They can be minted by a variety of methods, but most are created through a process known as mining, which requires energy-intensive computers to solve complex math problems in order to verify transactions on the cryptocurrency's public ledger. Why do people invest in crypto? People invest in crypto for the same reason they invest in anything. They hope it will rise in value, netting them a profit. Bitcoin, for example, is a popular cryptocurrency that has seen its price skyrocket over the past few years to trillion-dollar valuations. The cryptocurrency market is highly volatile, however, and it is possible to lose money on a coin you purchased in hopes that it would increase in value. The cryptocurrency market is also unregulated, which means that investors don't have the same protections as those who invest in more traditional finance products. When a Canadian buys cryptocurrency, the funds go directly to the person selling it, which could be an exchange or a broker service. It's important to choose a platform that is registered with the CSA and FINTRAC and offers insurance in case of any theft or loss. Some people also use cryptocurrencies to earn passive income by helping verify transactions on the blockchain protocol. This is called staking and can help grow a user's cryptocurrency holdings without the need to purchase more. Lastly, many users like the fact that cryptocurrencies remove central banks from managing the money supply, which tends to reduce its value through inflation over time. In 2023, our research showed that people who invested in cryptocurrencies were more likely to have higher household incomes and live in wealthier zip codes than those who were familiar with the technology but hadn't invested. It's important to note, however, that gains and losses on cryptocurrency investments are taxed just like any other investment. If you're considering investing in cryptocurrency, it's best to consult with a tax professional. Popular token cryptocurrency may be best known for buying drugs on the dark web, but it also has plenty of legitimate uses. For example, coffee shops in Vancouver and Calgary now accept payments in Bitcoin and Ether. Some office buildings even let tenants pay their leases in cryptocurrency. And many people invest in crypto because they want to take advantage of its rapid growth and potentially high return potential. While fiat currencies like the Canadian dollar are issued and regulated by governments, cryptocurrencies run on decentralized networks that aren't controlled by any one person or organization. These networks also make it impossible to fake or alter transactions, which is why many consider them safer than traditional money. In Canada, cryptocurrencies are categorized as securities, meaning they can be traded like ETFs or shares, but they're not yet legal tender. However, that doesn't mean they aren't gaining popularity. According to some experts, cryptocurrencies are the future of digital finance and could eventually replace traditional currencies. As a result, it's important to understand the risks and benefits of investing in this new technology. Some experts believe that cryptocurrencies have the potential to disrupt traditional financial institutions and replace central banks in countries around the world. This is because cryptocurrencies offer more flexibility, speed and security than traditional currencies. So if you're interested in crypto, the first step is to research the different coins and decide which ones are right for you. Once you've done that, you can buy your chosen coin on a trusted exchange, such as MoonPay. You can use a credit or debit card, Apple Pay or even a bank transfer to purchase your coins. Then, you can start trading and using them to make payments. Regulatory environment. Cryptocurrency has been a hot topic among investors and consumers, but it's not without its challenges. As digital currencies become more widely adopted, many governments have stepped up their efforts to regulate the industry. In particular, they've been implementing stricter rules and policies to help protect consumers from scams and other dangers. Canada was one of the first countries to establish laws and regulations addressing cryptocurrency. In 2014, it became the first nation to introduce anti-money laundering measures for virtual currencies by amending its Proceeds of Crime and Terrorist Financing Act. This law imposes reporting requirements for international monetary transactions, and it's meant to discourage the use of cryptocurrency for money laundering purposes. Provincial securities and derivatives regulations also govern the regulation of cryptocurrency. The CSA, an umbrella body that includes provincial securities regulators, has outlined various guidelines to ensure that existing regulations apply to the industry. These include provisions for prospectuses, registration of dealers and advisors, and exchange trading rules. However, it's important to note that cryptocurrencies are not considered legal tender in Canada. The only legal currency in the country is banknotes and coins issued by the Royal Canadian Mint. In addition, it's important to remember that investing in crypto is a risky venture. This is why it's critical to thoroughly research any investment opportunity before making a purchase. As the cryptocurrency market continues to evolve, it's essential that Canadians stay on top of new developments. By taking a proactive approach to regulatory compliance, they can help keep their investments safe and maximize their returns. Ultimately, this will be a win-win situation for everyone involved. So, what are you waiting for? Start researching your next crypto investment today. Can Canadians be paid in crypto? Cryptocurrency is growing in popularity, but it's important to know the difference between cryptocurrencies and traditional currencies. While cryptocurrencies can be used to buy products and services, they are not legal tender and therefore cannot be exchanged for Canadian dollars. That means they are not regulated by the government and have no value beyond what people assign to them. As a result, the price of a cryptocurrency can fluctuate wildly. The Bank of Canada is working on a project that uses blockchain technology to increase the speed and efficiency of high-value interbank transfers, but it doesn't plan to introduce a central bank digital currency (CBDC). Only a few central banks around the world have issued CBDCs, which are a form of national money that's guaranteed to retain its value. However, it's still possible for businesses to accept cryptocurrency payments if they want to. Many online and brick-and-mortar stores now offer the option to pay in Bitcoin or other cryptocurrencies to improve customer experience and security. A big challenge for the cryptocurrency industry is keeping pace with the rapid changes to banking and finance, Wilkins says. There is a need for major investment in domestic and cross-border payments, as well as digital governance, she adds. It's also critical to be aware of scams that can occur in the crypto market. Never invest more than you can afford to lose, and always use reputable platforms that have been vetted by regulators. Be wary of deals that seem too good to be true, and don't share your private keys with anyone. Finally, be sure to report any profits from trading crypto as income on your taxes. The Canada Revenue Agency has a helpful guide to help traders stay in compliance.